company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit. Modest compared to what has actually happened, and I am the most surprised person on this planet as to what's happened to Amazon.com. I think anybody who would have guessed the actual outcome would.
When the stock market opens its eyes to reality, even the giants can fall. In late 1990, a major financial publication ran a cover story with a simple headline, Amazon Bomb. The image showed founder Jeff Bezos' head attached to a cartoon bomb with a lit fuse ready to explode. The article dismissed the company as nothing more than another middleman destined for failure. At that moment, few could have predicted that this struggling online bookseller would one day become the world's largest marketplace. But between that moment and today's trillion-dollar empire lies a story of survival that pushed one company to the absolute edge of collapse. The journey began in 1994, when Jeff Bezos left his comfortable Wall Street career to chase what most considered a wild dream. He had discovered a startling statistic about the internet growing at 2,300% per year. From his garage in Bellevue, Washington, Bezos built makeshift desks by attaching legs to doors purchased from Home Depot. The choice of location was strategic. Seattle offered proximity to Microsoft's talent pool and, importantly, no sales tax obligations that would exist in California. Bezos had initially explored selling music, groceries, and other products online. But books won the race. The market was enormous, with Americans spending $19 billion on books in 1994. Books were lightweight and easy to ship. Most importantly, no physical bookstore could stock the hundreds of thousands of titles that existed. Amazon could offer them all. The company launched in July 1995. Early growth seemed promising. When Yahoo featured Amazon on its homepage, orders poured in from around the world. The small team scrambled to keep up, working from a converted garage with minimal resources. To raise capital, Bezos pitched 60 potential investors. Only 22 believed in the vision enough to write checks. They invested $50,000 each, bringing in $1 million in exchange for 20% of the company. Bezos' parents also invested nearly $250,000 of their savings. By 1997, Amazon went public. The company had $16 million in revenue and 180,000 customers across more than 100 countries. Wall Street buzzed with excitement about internet stocks. Everything with .com in its name seemed destined for riches. Amazon's value soared, reaching over $100 billion despite the fact that the company was burning through cash with no profits in sight. But Bezos had bigger ambitions than selling books. He envisioned the everything store, an online marketplace that could sell any product imaginable. In 1998, Amazon aggressively expanded. The company spent $175 million acquiring a payment processor called Accept to launch Amazon Auctions, hoping to rival eBay. Another $170 million went toward buying Junglee, a price comparison site. Millions more poured into partnerships with sites like drugstore.com. The company entered toys, electronics, and countless other categories. Every move seemed designed for explosive growth rather than careful profit building. Critics grew louder. The respected analyst George Colony from Forrester Research publicly called Amazon toast. Skeptics pointed out that the company had never turned a profit. Traditional retailers like Barnes & Noble and Walmart were finally building their own websites. Why would Amazon survive when these established giants entered the online space? Then came May 31st, 1999. The Barron's cover story landed like a bomb itself. The article brutally dismissed Bezos' vision, calling him just another middleman. It predicted that direct-to-consumer companies like Sony and Dell would dominate online retail. The piece highlighted Amazon's slowing book sales growth and questioned whether the company could sustain its expansion. Most damaging, the article suggested Amazon would run out of cash within months. The timing couldn't have been worse. Amazon's stock price had already begun falling from its peak of over $100 per share. The Barron's article accelerated the decline. Within days, shares dropped toward $50. But this was just the beginning of a far more catastrophic collapse. By early 2000, the entire internet economy stood on shaky ground. The dot-com bubble had inflated beyond reason. Companies with zero revenue commanded billion-dollar valuations. Investors threw money at anything with a website, ignoring fundamentals like profit or sustainable business models. The Federal Reserve raised interest rates to cool the overheated market. In March 2000, the bubble finally burst. The crash was brutal and swift. The Nasdaq Composite Index, heavy with technology stocks, plummeted 78% over 2 years. Hundreds of internet companies vanished overnight. Well-known names like Pets.com, Webvan, and Cosmo collapsed despite raising hundreds of millions in funding. Many of Amazon's own investments disintegrated. The partnerships and acquisitions that cost Amazon hundreds of millions became worthless. Amazon's stock entered freefall. From a high near $107 in late 1990, shares crashed to just $6 by September 2001. The company lost more than 90% of its market value. For investors who bought at the peak, watching their holdings evaporate must have felt like financial torture. By April 2001, Amazon stock traded at $8.37. The 92% collapse seemed to validate every critic who called the company a disaster waiting to happen. Inside Amazon, the situation looked equally dire. The company was still hemorrhaging cash on expansion and infrastructure. Headlines screamed that Amazon would run out of money. Bankruptcy seemed like a real possibility. Most dot-com companies in similar positions simply ceased to exist. But Amazon possessed something most failed internet companies lacked. The company had real customers who actually bought products. While revenue growth in books had slowed, total sales kept climbing as new categories attracted shoppers. More importantly, Amazon had secured crucial financing just before the crash. In January 1990, Chief Financial Officer Joy Covey led a $1.25 billion convertible bond offering. The timing proved miraculous. Amazon closed the deal just 1 month before the market collapsed. That cash infusion would prove to be Amazon's lifeline through the storm. Jeff Bezos refused to panic. While investors watched the stock price crater, Bezos focused on different metrics. Customer numbers climbed from 14 million to 20 million. Efficiency improved. Every operational indicator pointed toward a business becoming stronger, even as Wall Street declared it dead. Bezos wrote to shareholders explaining his philosophy using a quote from investor Benjamin Graham. In the short term, the stock market is a voting machine. In the long term, it's a weighing machine. Bezos declared that Amazon wanted to be weighed, not voted on. The company would build itself heavier and more substantial regardless of what the stock price said. This long-term thinking guided crucial decisions. Amazon invested the bond money not in desperate survival moves, but in infrastructure that would pay off years later. The company built distribution centers and refined logistics. It developed technology platforms that would eventually transform retail and computing. Instead of chasing quarterly profits to please investors, Bezos doubled down on the vision that initially drew skepticism. The strategy worked, though it took time. By 2003, Amazon finally posted its first annual profit. The company had survived when countless others failed. In 2005, Amazon launched Prime, offering unlimited fast shipping for an annual fee. Critics called it insane. How could giving away shipping possibly make money? But Prime locked customers into the Amazon ecosystem. Members shopped more frequently and spent more per order. The bet paid off massively. That same period saw Amazon quietly building what would become its most profitable business. Amazon Web Services launched in 2006, offering cloud computing infrastructure to other companies. This side project eventually generated billions in revenue and supported Amazon's retail experiments with enormous profit margins. The distribution centers, the technology investments, the focus on long-term infrastructure over short-term profits, all culminated in an unstoppable competitive advantage. Today, Amazon stands as one of the world's most valuable companies, with a market capitalization exceeding $1 trillion. The company delivers billions of packages annually through its own logistics network, employs over 1 million people, and touches nearly every aspect of modern commerce. Those who invested $1,000 when barons predicted doom would now hold shares worth tens of thousands. The story of Amazon's near failure reveals something essential about innovation and persistence. The company came within months of running out of cash during the dot-com crash. The stock lost 94% of its value. Every expert predicted failure. Yet Amazon survived because it built something real beneath the hype. Real customers, real infrastructure, real long-term thinking. Sometimes the difference between collapse and triumph isn't avoiding the crisis. It's having the conviction to build through it, while everyone else runs for the exits.